Audio test. Hello? Am I coming through? Okay. So maybe I should go over the trades here for you guys. Hold on 1 second. Okay, so let's uh let's use this 15-minute chart here for a second. Let me show the fills. A lot of trades, a lot of contracts. Um this over here, I mean, I was up over 10K here once it starts dropping. So once I saw this big drop, I knew there's gonna be a follow through, but it just kept going up and the retesting. Um, so I almost lost all the profit when I hit this 20-day moving average. But then once it formed this topping tail, I knew it was going down and start adding and getting out on this bar, as you can see here. So let's flip over to the 15-minute chart and let me show you why also I went short. Oh, what is this histogram? What is that? Okay, so we got these two moving averages, the 40 and the 50. So once it failed to go get above this high and it formed this red bar, I knew we are gonna go down. I mean, I was surprised of this move up. I mean, this was just stupid, insane, right? Because it almost erased the whole move down. I mean, it retraced like 70%. Crazy. Um, anyways, but then since we're kind of in a bearish scenario now, um, I knew possibly at the end of the day we're gonna see um, pull back to the downside, and so we saw that. So because these moving averages are declining, so once I took the profits here, this is the 15-minute chart. So as you can see, we first went up. I was really just didn't like, I wasn't liking this at all. Um, I figured it was gonna go retest this 20-day moving average, came back down, which it did, but then the next bar did the same thing and went past that, so I got worried and almost got out at even. But I held on and reversed, and the rest is history, right? So that's the reason. Now we're hitting this green bar here. So um, the thing is, I want to show you the daily chart, but so this is the reason. This is not accurate. These charts are not accurate, the daily, because see all this, because the contracts are not continuous. They're just um, this is the most active contract. Uh, but let me see here. So so the low of the day we hit on this chart. This chart is wrong. So the bottom of this candle, the low, we hit the 40-day moving average, and that's why we retraced. But we retraced way too much, as you can see. I mean, this is just ridiculous. But so then I said to myself, so now it's having a hard time going even further. Pull back and then continue. So once I saw this here, and then it rolled over. So like I said, so it retested this 20-day moving average. It went past that a little bit, which I said I didn't like. So kind of when you look at this tail here and when you go across, it tested these tails here, the bottom of this. Uh, but usually it retests the moving averages and then comes back down. So I like this bar, this 15 minutes, but it just uh, it tried again and it got me worried. But then once when I saw this right here, let me just take these fills out, the topping tail, and I said, okay, so we're going back again, going back down. So that's it. Those are the trades. Got the loss back from Sunday Open, and let's see what it looks like here on the 30 minutes. Okay, so I didn't even look at the 30 minutes or the hour before. Oh, okay, now it makes sense. I mean, I didn't like this move up. This just went too far. Like 70%, 75% retraced of this move. I don't like that. Usually goes about 50% or so, 50, 60%, and then rolls over, not that high. So, and the 4 hour is wrong. It's just never. Yeah, I don't like these 4 hour charts. Anyway, so that's the trading for Monday. So tomorrow's going to be the last day of 2024. It's going to close out the year. Um, Let me take a look here for a second. Hold on 1 second. Okay, so let me just show you guys on a different platform what happened, which is more accurate. The charting is a lot better. Let's see. Okay. I'm not used to, okay, so as you can see here, this is the daily bar on NQ. It hit the 40, and this tail was a problematic also, so that's why we pulled back. But it was a little bit too deep, like I said, on the 15-minute chart. Um, so tomorrow, let me see, where's this? So I think tomorrow is going to be continuation of the downside. Um, what I would like to see is go all the way down to this 50-day moving average. That's what I think is going to happen. They're going to just take profits for the year and move down. Let's see, we're at 21,390, so 21,400. Um, so 21,1, so another 300 points down. Not a problem. We went down 300 points today, so another 300 tomorrow, which would, let's take a look here for a second what the, God, I'm not used to these charts. Let me see if I uh, been using these. Okay, so this is the weekly chart. So 21,000 is right here. So if that happens tomorrow, even 21,1, yeah, but I think 21, I think they might close it at 21,000. And then the monthly, this is what the monthly looks like. So the monthly, yeah. So if we close tomorrow and form, and this bar turns red, which would be right at 21,000. So let's see, this opened at 20,995. So just below 21,000. They might. Who knows? We might get 500 points down tomorrow. Who knows? It's Friday. I mean, it's Tuesday, but last day of the year. So Santa Claus rally is over. Um, so that's what I think. Let's see. There's the daily. So I called on this day, this red day, that bull market is over. We have put in the top, and we rolled over, and we're going to the downside from now on. Of course, we're gonna have pullbacks to the upside, and then like here, up, down, up, and down. So I think so. That's it for this stream. Don't forget to subscribe, hit the like button, and hit the bell notification icon. And um, this is the day. We'll see you in the next video, in a live stream. Take care.
On December that part. And the market was like, oh my God, the fact that, by the way, all measures of inflation had bottomed out in the third quarter and had been going up for several months. Nobody cared, right? The market kept going up. But as soon as he said that, much like in 2022, when you saw the market go down 19% as the Fed finally admitted inflation wasn't transitory, I think that might have been the wake-up call, which is why I think Q1 could be a really rough time for a lot of the market as a whole, but a lot of the mega cap stocks as well, as we have to kind of price in the fact that the Fed might, they might pause or they might even raise next year, which I think that's a 50-50 shot of whether they cut or raise or hold.
So you think the reigniting of inflation is a very real risk here? What does that mean not only for stocks, but for other things like the dollar, which you just mentioned, and the bond market and other asset classes?
Yeah, and that's really what I'm looking at, because I've written about this for, I don't know, several months at least, that the thing I'm watching the most is 10-year Treasury yields. And the Fed now has cut about 100 basis points. 10-year Treasury yields during the same time have gone up about 90 basis points. And if you say, okay, CPI is at 2.7%, what has the market multiple been in the past when CPI has been 2.7%? The S&P multiple has been 19 times. Right now it's sitting at 25 times. So you don't have a lot of valuation support. The other thing is 10-year Treasury yields have typically been over 100 basis points higher when CPI has been at this level. So you could argue, hey, there's potentially you could lose money in both bonds and stocks next year. I mean, obviously, this is a very light last week of the year. This is going to get a lot more interesting when everybody's back from vacation in early January, and you combine that with, hey, we've got these massive gains that we wanted to postpone until this year, when we might get maybe lower taxes with Trump back in office. Who knows? That you could have a big sell-off at that point to start the year as those gains get postponed.
So, stock, sector, asset, what are you most excited about for 25 then?
Cash. I think investors should think about going into next year with a fair bit of cash on the balance sheet because of some of these things. And we haven't gotten into things like there's no election. Well, there was a huge amount of spending in the fourth quarter. That goes away in Q1. So that makes it kind of tough for Meta and Google. Easter shifts out of March, from March 30th of this past year to April 20th, or March 31st to April 20th this year. So that makes it tough for an e-commerce name like Amazon. So I think cash is a pretty good thing. I'm looking at small, mid-cap ETFs. Those are good places to be if you feel like you have to be invested for some reason. But I'd be very cautious of the momentum names that got us here, because that might be where some of your risk is if people want to rebalance to some of these other non-sexy, non-AI places like smaller mid-cap stocks.
Okay, some actionable insights there for our viewers. Dan Niles, thanks for joining us. Happy New Year.
Happy New Year, guys.
After the break, trouble on the home front? Housing stocks have had a rough month, but could a turning point be coming in the new year? We're going to ask the CEO of one of the country's largest single-family homeowners, Invitation Homes, next.
And later, 2025 could mark a major shift in return-to-office mandates. We'll talk about why some blue-chip companies are cracking down on remote work and if employees will have the power to push back.
Welcome back. November saw pending home sales increase for the fourth straight month to their highest level since early 2023. And this comes as home construction stocks are on pace to close out their worst month since March of 2020. But joining us now is Dallas Tanner, Invitation Homes CEO. Dallas, it's great to have you back on the show. Welcome.
Hi, Morgan. Good to see you. Happy New Year.
Happy New Year. So you were on with us back in May, and you talked about the fact that you were seeing insatiable demand, that you were seeing the lack of housing supply was helping to fuel that. You expected additional pricing pressure on housing for most of the year. What are you seeing now as we head to 2025? And even though we've had a Fed that's cut a couple of times, we have Treasury yields and thus mortgage rates still very high.
Yeah, interest rates have proven, a little bit difficult to forecast. I think everybody's dealing with that near term. What we found is sort of at the mid part of the year, we start to see demand definitely start to normalize, which we view over the long haul as something that's extremely healthy for the consumer. What's been, I think, most interesting along the way has been this propensity for customers that are in place or have housing solutions figured out to continue to renew and are continuing to stay in the for lease business longer and longer. Seems like the home builders are getting a little bit of that, kind of coming back to earth process happening as well, but it's still incredibly healthy. There's not a tremendous amount of supply in the marketplace. And so if you have something, you're probably in a position where you want to hold on to it. If you're fighting for that customer today, you have to fight a little bit harder than we did maybe back in May.
Interesting. So we know that the inventory has continued to be tight. We also know home builders have stepped in to at least begin to make up some of the difference, even as mortgage rates have stayed high and existing home sales and sellers that have low mortgage rates are basically golden handcuffed, quote unquote, in their current properties. What does it take to see that balance out and that piece of it normalize more? And I ask that knowing that you have, in the process, struck deals with some of the home builders to be able to acquire more inventory yourself.
Yeah, we've got an incredible business right now in building new product. We have roughly 2,000 units under contract or in contract to be being built at this point in the marketplace. And it feels like with our national home builder partners, there's an opportunity to probably do a lot more of that here in the future. I think, the mortgage rate thing's been really sticky, right? And in our markets, for example, at the end of Q3, it's about $1,000 on average cheaper per month to lease than it was to own. Now, that's not an indication of where home builders or for lease product might be at any given time, but it certainly weighs on people in their near-term decision making. And so as you think about that, as if you're a family, $12,000 a year cheaper to lease than maybe to own, that probably does hurt some of the retail sales market. But again, it's been such a lack of supply over the last 5 years, 6 years. Builders have done really well. I think on the for lease side of it, we've got to continue to lead in, build more of what people are calling BTR, these fully stabilized, fully encompassed rental communities where families can be completely down payment light, right, build credit through positive credit reporting, and also have that same lifestyle, but be not out as so much upfront in your upfront costs.
Dallas, an interesting column in the Wall Street Journal last week pointed out that in the U.S., a record 4.1 million people a year are going to turn 65 each year for the next 3 years. So what's that going to do to existing home inventory based on any downsizing trends that you might have seen and to the type of demand for new homes?
It's a really good question, John. So, what we've seen is we have seen boomers or some of these preferentials, as we like to call them internally, choose to lease in other markets or have a second home as part of their flexible living. I think it's TBD in terms of how many of those boomers actually become sellers or completely change the way that they think about living. I do think it adds added pressure, though, in the for lease markets as people want, and we've all seen it, especially since the pandemic, a lot of people want to spend more time in warmer markets. And if you look at how our portfolio has been constructed, we're largely Sunbelt and Southeast markets with higher density in markets like Florida, Georgia, and the Carolinas. Those are excellent places for people to retire. So we'll expect that we'll have continued, pretty high demand in those markets. Maybe for our preferentials or people that are aging out, that's a really interesting decision that we'll have to watch how those demographics shift. And even funnier stat, John, is that something like 12,000 people a day are turning age 35. And our average customer is 39 today. That is like our sweet spot from a customer demographic perspective. So for the next 10 years, there are 12,000 people a day turning 35 that are making these decisions around flexible living. Do I want to own? And I think the market's going to keep adjusting. You see it in the type of product that new construction and what they're building. The home builders, they're not building really small homes, you know, in infill. They're building 2,000 to 3,000 square feet, a little bit higher price points, which is much more of a move up or maybe even a third buyer. So, you know, shifting demographics are definitely going to be part of what everyone's going to have to figure out over the next several years.
Demographics are destiny. Dallas Tanner, thank you.
Thanks.
Well, it's time for a CNBC News update with Angelica Peoples. Angelica.
Hey, John. The Justice Department said today that more than $131 million has been distributed to more than 23,000 victims of Bernie Madoff's Ponzi scheme. The agency said it's the 10th and final disbursement from the Madoff Victim Fund, which has now returned over $4 billion to more than 40,000 victims. Venezuela's top court fined TikTok $10 million over viral challenges that killed 3 children and injured dozens of people in recent months. In today's ruling, the court said that the fine must be paid within 10 days. This comes after the court ordered TikTok officials to address the deaths in person last month. TikTok has yet to comment. And by New Year's Day, the world's population will hit just over 8 billion people. Estimates released today by the U.S. Census Bureau show that the world's population increased by more than 71 million people in 2024, almost 1% in the U.S. The Census Bureau says there will be a total of 341 million people in the country at the start of 2025. Back to you.
Consumer discretionary stocks pulling back today. And a looming tariff fight in Washington could put more pressure on retailers in the new year. We're going to discuss what's at stake with former Walmart U.S. CEO Bill Simon next.
And later we'll talk about whether or not a comeback is in the cards for energy stocks after a dismal year of returns. We'll be right back.
Insurance.
Welcome back to Overtime. Retail stocks getting hit in today's pullback with names like Kohl's, Macy's, and Five Below all down more than 3%. Now, it comes after a strong holiday season, but tariff risks are weighing on the minds of retail executives and consumers alike. Joining us now is former Walmart U.S. CEO Bill Simon. Bill, it's great to have you back on. Before I start getting into what you're watching for 2025, I do want to get your thoughts on what we have seen this holiday season so far from the early data we've gotten, especially since between Thanksgiving and Christmas, we had 5 fewer days.
Yeah. Hey, Morgan. Good to be with you. By all indications, it's been a pretty good holiday selling season. The credit card data is up significantly, and anecdotally, store checks show that sell-through on seasonal merchandise is as good as it's been in 3 or 4 years. And both of those would bode well for a good sales report for the holidays. Traffic at the malls and discounters and department stores, particularly even in department stores, hadn't seen robust traffic in a while. All look to be up as well. So I'm encouraged by the holiday sales.
Do you think that continues into 2025? I mean, we saw a jump in U.S. credit card defaults to the highest level since 2010, and now there is tariff talk.
The consumer is nothing but resilient, and they sort of figure out how to move forward given whatever's happening in the economic world that they live in. I think one of the things that I'm looking for in the coming year is food prices. If food prices stay stable, I don't think they're going to go down much, but if they don't go up much, I think there'll be more disposable income for consumers for some of the other segments. So I think that's a positive. As far as tariffs go, this is really just round one of the tariff discussion. Somebody fires a shot across the bow, somebody fires back, they negotiate, they may or may not end up with a tariff. And ultimately, in the end, the consumer decides if they're going to pay the added premium for the product that has a tariff on it, or are they going to change their purchase pattern and buy something else.
Well, Bill, on consumer behavior, shopper behavior, last week I was out in Orange County, California. Irvine Spectrum Mall was packed. I mean, just really packed. What has changed since before the pandemic, if anything, or are we just back to in-person shopping, at least for the nicest malls, being a big thing?
No, I do a series of store checks, both pre-Christmas and post-Christmas, just to gauge. And I wasn't in Orange County. I was in, urban, suburban, and even some rural markets. And I saw very robust traffic everywhere that I went. My view is honestly that after a really, really difficult and chaotic election season, whichever side you're on, it's finally over. And I think people are breathing and shopping and sort of back to living. Both sides said democracy was going to end. Well, it hasn't, and we're moving forward, and they're moving forward. How long it lasts, I think, your guess is as good as mine.
What about the mix between goods and services?
I think that there was a real push on services, pandemic, post-pandemic for several years. And that pendulum is starting to swing back. I think people are realizing that eventually you do have to buy some apparel and things like that, those hard goods, soft goods that were on pause for so long. We're starting to see movement in those categories now as well.
Finally, how closely are you watching the rising risk of a port strike come January 15th?
Yeah, we get to the precipice here with port strikes. Periodically, we had one not too long ago and walked back from the abyss. Look, if there's a prolonged port strike and it will disrupt the supply chain and cause havoc. If it's a day or a week or even a couple of weeks, the supply chain has the ability to absorb that. I'm a believer that they rattle sabers and then settle. And I think that's what's going to happen.
All right. Bill Simon, great to have you with us. Happy New Year.
Happy New Year to you. Thanks, guys.
Well, if you thought the action in equities was volatile today, just look at natural gas prices, which surged double digits. We're going to break down what's behind that big move next.
And check out the biggest decliners in the energy sector in 2024. Apache, Devon Energy, SLB, among the biggest losers. Stay with us.